Part 8 under risk management. For new trader, which profits are number one priority? For rich trader, managing risk is number one priority. There's a lot of things to learn in this part, a lot of things. I will just fish out the most important part here for us to learn from. You understand that from this part, we have different kind of risk. We don't only have the risk that we know. There is one risk that we know. That risk of losing money, you stepping your stop loss and the market eating you out. We have risks that are more than that. They are even in this book, he even listed up to 11 type of risk that we face in the market every single day. Now let me just read some few things, some few conversation between the rich trader and the new trader. First thing the next morning, new trader was knocking on the rich trader door. Rich trader opened the door after a few minutes. Hello again, rich trader said in his usual pleasant tone. You called this time at least. New trader grinned. Of course. New trader grinned. Of course. I have come for class, professor. Well then, I am afraid I don't have any lecture prepared today, but why don't you come in, have a seat and tell me about what you are curious about? So when new trader comes in, he asks questions about risk. He said he think risk has to do with a lot of things than what he knows. Because he's struggling with a lot of experiences, on risk management. Well, risk seems to be much deeper, a more important topic than I thought it would be. Risk is like a Cerberus, and it can bite a trader many different ways. Different trading methods expose you to different kind of risk. Cerberus means something that has different ways. It can different faces. You get the point now. So, like what he means there is like risk. It has different faces. Different type. That's what he means there. I thought risk was just the chance that you could lose money. It is, but there are many ways you could lose money. Now let's go on. Number one way, you have the basic risk that your trade will be a loser, that it will move in the opposite direction of your long or short position. This is trade risk. However, most time you can control the maximum amount you lose through position size and stop loss. You also have the general market risk factor. You can pick a stock of a wonderful company, but if the trend of the stock market itself is down for some reason, the likelihood is that your stock will also fall, regardless of the fundamental merit of the company or the past trend of your stock's price movement. The market is like a tide that comes in, lifts up all the ships, then goes out and lower them back. Number 3, you have the risk of your stock either being or becoming highly volatile. Volatile risk can scare you into selling your stock too soon or simply cause your system to stop working because the stock you bought hit your predetermined stop loss and force you to sell, even though it might reverse and be right back where it started later that same day. It is the burden of a stock price range from its past history. You see how deep risk is, and these are the things we all experience in trading. These are the things, but we did not know that risk has different faces like this. So let's go to number 4. Overnight risk is when something unexpected happens while the market is closed and the next morning your stock gaps down in the pre-market and you never even had a chance to sell and stop your loss. This risk applies to everyone except day trader or trader who trade markets that are open 24 hours. Number 5, liquidity risk is when there are just not many buyers or sellers for your stock, so you lose money in bid spread. The bid is what the market maker is willing to buy your stock, and the ask is what they are offering to sell it for. So the difference between your bid and your ask, when you take a trade, it is always be on loss, except the market moves to your direction instantly. So the reason it is on loss is because of the liquidity, the difference between what ask and the bid price. So there are some currency that their liquidity is so wide that if you enter a market like just once, you enter a market, it will the loss is going to give you is going to be so big. So that's why you need to be careful of the kind of pairs you are trading, so that before you even have a chance to trade at all, you will not be losing too much money. So there is also the risk of error, where you can actually put one too many zeros on the amount of shares you want to buy for a trade, or buy the wrong symbol, or sell a stock short instead of buying it long. Double check your trade before you place them is very important. This one is even likely is this one is like this one is even talking to mostly everybody that is a trader. You need to be very careful and double check your trade before you pull the trigger. So another type, one of the most frustrating kind of risk of all, is technological risk. If trading is not hard enough already, you can also have your internet connection crash or broker trading platform go down while you are in a trade. These are good reason to have a backup plan, like the phone number for your broker ready at the push of a These are good reason to have a backup plan, like the phone number for your broker ready at the push of a button to get out. These are the one I think they are very important for me to share with us from this book. So what are the solutions to this risk? What are the solutions to all this type of risk? Do you see that risk is more deeper? Even we have political risk, we have leverage risk, we have any risk. All those risks, they are so enormous. Risk is so deep. So these are the solutions. Number one solution is determine your stop loss before any trade is placed. Number two, honor your stops. Cut your loss. Number three, trade the same size of dollar value in every trade to even out your loss with your win. This is what I mean here. It's just like when you are trading with a kind of position size, you must make sure that you continue with that same position size. Don't decrease it and don't increase it, so that your win will balance what you have risked at any point in time, though you should be on your trading plan. Number four, only take trades that meet the criteria of your predetermined trading plan. This is very important. Trade mostly long in uptrending bullish market and mostly short in downtrending bearish market. A 10-day moving average over 20-day moving average is a good sign of an uptrend, and the reverse is a sign of a bearishness. Only trade in stock with over 1 million or more share traded a day, an option with open interest over 1,000 contracts. This is very clear. This is why we need to be very careful of what we trade in the market. We must make sure that it is what mostly everybody trade, so that it will actually tighten the leverage. Remember to always double check trade information before you hit that last trade button. I have accidentally traded 10,000 shares instead of 1,000. I have also accidentally traded a stock long when I meant to short it. This is a real risk like any other. And you need to have a plan B for your broker and internet connection. I always keep my broker in my contact on my cell phone, and I also have the internet on my phone to check the stock price. Now, these are just the solutions that can solve a lot of issues we have about risk, and it will not be solved if we do not follow all this. It's just like if you do not follow your plan, you will not be profitable. You need to have a trading rule. You need to have a trading plan. So risk is very important. If you have not even calculated your risk, don't trade at all. So bye for now.